Greg, good to see you again, man.
Pleasure to be here. Thanks for having me, Peter.
Man, I would have you on the show whenever you want to come on the show.
Okay.
It's good to do it in person.
Yes.
We're back out recording. You happy with you got your buddy Peter
That
Schiff
is
there?
something else, guys. Thank you for just for full disclosure. I didn't bring the photo of Peter, but Peter Schiff we're talking about. But I'm much appreciative of having him at the table with us.
You're gonna be able to keep your cool.
I think we did okay the last time, right? That was a good experience. The highlight of it for me was basically when he said he didn't care about being a fiduciary responsible risk manager. And, that's not what you want to hear if you're one of his unit holders. That being said, he's a good marketer. Let's give him that.
Yeah.
And you know what? I did see something afterwards from his son. His son, not blowing him up, but he did text me privately a DM and said, "Do you think I'm being too harsh on my dad?"
Wow.
And I just basically said, "Look, kid, all I know is your dad and you are special, and don't let something like Bitcoin destroy a relationship. That would be dumb." So.
It's so funny watching them go back and forth against each other. I dread the day my son comes on and starts ripping me and everyone's supporting him.
That is interesting. I wonder if I'd be cheering it if that's how I wanted it to be set up, right?
Yeah.
Let's just say Peter is that smart, which I'm not going to say he's not. Imagine this is the plan.
Could be.
And if that's the plan, he's doing a magical job of it, right?
Well, it's a shame for his clients, though.
That has not been a concern of his for the last 10 years, clearly.
Yeah.
Imagine if he had put the 1% of the portfolio in to Bitcoin when he was first introduced to it. He'd be the best performing gold fund manager or hard money manager ever in the history, because it's up, 10,000 times, which would mean that he'd be up tenfold, 10,000%. So tenfold on the 1%. His whole fund would be up tenfold just on a 1% allocation.
Unreal. The idea of a hard money fund is pretty cool, where it'd be mixed assets.
Okay, they're doing it in Canada.
Uh-huh.
Okay, so one of the funds that's going to be marketed in Canada now is exactly that, is an ETF that holds a portion of Bitcoin and a portion of gold, and probably another sleeve that'll allow certain other discretionary hard assets. Could even be a real estate portion of the fund.
Yeah. Do you think, is it a fund that will rebalance?
So, not certain of the technicalities involved, but a lot of these funds can have discretion, and that's how the manager charges a higher fee, right?
Yeah.
If they have discretion, they argue that it's an actively managed fund, and therefore you have to pay a higher management fee. But then it becomes a question whether it's a closed-end fund or an ETF. If it's fixed on the asset base, then the ETF is easy to get.
Right. Well, listen, we're here to talk about bonds again. We're always talking about bonds, but we'll talk about some other things. We might talk about some mining and some other stuff. But I want to do another kind of 101 on bonds, just because I want to talk about the Volcano bonds,
perfect.
the El Salvador Volcano bonds. So I just want to reintroduce people to what they are, how they work, because the current Treasury bonds, you've been very critical of. You think anyone who's buying that is a moron right now.
I saw you say that with Lynn, and I do say that within a soundbite. There's people that trade them, and a guy that I met actually at Mark Moss's event a couple of weeks ago, Stephen Van Meter, and he absolutely is a bond bull. But he is a bond bull for a specific event that I believe Bitcoin will far outperform bonds in that event. And Bitcoin wouldn't have the downside if that event doesn't occur. And, let's put it this way. You can trade a bond. He freely admits he will not own a 30-year bond for the next 30 years. And that's what I'm critical of. A pension fund that holds a bond, like a 30-year maturity bond, that will hold that bond for the next 30 years. Then we know for certainty that their return will be what the current yield is right now, call it 2%, okay? Who will own a bond for 30 years and earn an IRR, internal rate of return, of 2% annually? I wouldn't, especially when inflation is 6%, right?
I'm guessing the only people who will are the people who are mandated to, and that's all they can own.
Correct. Well, there's certain funds that are, absolutely just bond funds, and that's all they can own. A pension fund will be a mixture of bonds and equities, as you know, and those are fixed weightings within that pension allocation. So, and it takes a long time to change those allocations. So the traditional 60-40 model, which 60% equities, 40% bonds, to change that to something like 60-20-20, where 20 would be alternative investments and potentially Bitcoin, literally takes years and years. And there's the trustees of the fund that have to be convinced of it, and then the consultants of the fund have to come in and endorse that they're not doing anything reckless with the pensioners' money. It's not an easy process. So absolutely, over time, those antiquated 60-40 allocations will change, but they don't happen quickly.
Okay, so let's just go through the basic steps. Let's remind people what a bond is,
Sure.
Who issues them, and who buys them.
Perfect. A bond is a debt instrument, which means the borrower is signing a contract with a lender that establishes a maturity or a term to maturity of the contract and an interest coupon that is traditionally paid semi-annually, twice a year. That interest coupon adjusts the contract essentially for the risk of the borrower. So, who borrows? Governments. In the case of the U.S. Treasury, the 10-year U.S. Treasury at around 1.5% right now is the quintessential risk-free rate for the world, okay? The reason it's risk-free for the world is because people will say, well, European bonds have a lower yield than U.S. Treasury yields. That's true, but if you translate them back into US dollars, always start in the same currency, you'll see that the US Treasury is the lowest borrower in the world, with the exception of a couple of basis points here and there. Always look at bonds in the same currency to get a feel for what the coupon needs to be in that currency to reward the lender for the perceived credit quality of the counterparty. So, for example, just and to clear this up, let's say Peter McCormick came with a 10-year bond issue in US dollars and the US Treasury was 1.5%. What do you think you would have to pay in an open market transaction to borrow $10 million, Peter? And I'm going to guesstimate 6.5%. Why 6.5%? Because Michael Saylor, MicroStrategy, borrowed at 6 1/8%. So I'm going to say you're riskier than Michael Saylor, at least 7/8 of a percentage point.
We'll give you
7%. We'll say 7%, and you would borrow. And then you look down the line, and there's various credit ratings for the counterparties. These credit ratings are assigned by S&P and Moody's as a subjective evaluation of the credit risk. So you'll get different countries will have different ratings, different corporations will have different credit ratings. And I spent my life in the junk bond market, which was credits that are more risky than the typical borrower. They're not as risky as investing in the equities of that company, because bonds have priority of claim, meaning unless the bonds are worth 100 cents on the dollar, the equity of the same company is worth zero in a restructuring. So yes, I was a junk bond trader, but the funny thing I would always tell people is, okay, pejoratives aside, you're a super junk equity investor then, right? If the bonds are junk, the equity is super junk, and lots of people buy the equities of super junk companies. That's okay. Just remember, there's a price for everything, and a junk bond company will have to pay a higher yield on their contract, everything else being equal, because they are higher risk of default.
Right. Okay. So the US is seen as the most trustworthy issuer of bonds.
And not only trustworthy, they are the biggest. They are the most liquid. They have the world's biggest economy, right? So there's that absolutely. And the world basically functions on a US dollar. So there's always liquidity in US dollars.
Right. So the US will issue new bonds, which people may buy.
They have to buy them because there's no choice, right? In a debt spiral, DEBT spiral, which we are currently experiencing, meaning it's expanding, every single new bond issue is the result of an old bond issue maturing, and the new one has to replace the old one together with new borrowing that's taking place.
Is that to pay the principal?
Correct, sir. So let's just say a bond 30 years ago. 30 years ago, less 20 days, a 30-year treasury bond comes due. It was now a 20-day obligation because it was issued 30 years ago, less 20 days.
Yep.
In 20 days, it will have matured. Well, the treasury needs to pay that off with new borrowing. Isn't it funny? So a bond issue never actually matures. It actually rolls over. Okay? And that's the key. So every single auction that takes place is not really anything but the debt balloon refinancing itself. The key, though, that everyone needs to understand, that debt balloon is growing organically just because of the interest coupon on that debt balloon being bigger than the growth rate of the economy.
Right. Okay.
And that is key.
And so when a bond rolls over, really, I mean, its term ends. They issue a new bond to pay the principal of the previous bondholder.
Add a new coupon.
But the coupon will likely change.
Well, a number of things will change for the calculation of the coupon. The most that everyone's worried about is the inflation expectations. But my argument is that more issues or more investors will take issue with the credit quality because no country can fund themselves indefinitely. The U.S. will be the last fiat issuing country to fail, but it will fail. And that is not something I want to happen. And that is why we need to take precautions and, some very smart people out there trying to design a parallel system where you will have fiat obligations as well as a Bitcoin standard.
Okay, so you have the rollover, but is there also the issuance or the expansion of the number of bonds?
The number of bonds, potentially, Peter, but what really happens now is they do big benchmark issues. So they try and consolidate borrowing. So it's not really the number of bonds, just it's the cumulative total of the outstanding debt.
Yes. And this is where we get into one of the issues of expansion of the money supply. Is that, explain me if this is correct, but every bond has to be bought, but there is no buyer for every bond. So the US government themselves ends up buying their own bonds they've issued. So they print money to do this.
Correct.
This is the debt cycle.
That is largely true.
Yeah.
That is largely true. That is correct.
Okay. So, interesting. Okay. And then just as a reminder for me to understand is that one of the tricky problems with raising the yield is that all bonds are liquid. So you could buy a bond, but you can trade it at any point, sell it to somebody else.
Yes.
And so that's where you get your yield curve from. So if they issued a new bond, let's say a 7% one to cover for inflation now, that is going to reduce the value of all outstanding bonds with a lower yield.
Wow. That's an interesting concept. They would never issue a bond with a 7% coupon.
Because it would destroy the rest of the bonds.
Largely, yes. But think about it. If the market is charging them 1.5% for a 10-year bond right now, and that's a fluid market, they know that the next auction, they only have to pay another 1.5% to issue another 10-year bond. Okay. And that yield curve is well defined. Now, if they came out and said, we're issuing at 7%, first of all, they're paying way too much.
Okay.
And secondly, the price of that bond would cause all the other bonds to crater, but that bond itself would still trade at probably a 2.5% yield. So it would be trading at $160. And all the other bonds would be trading at like $60. Okay. It's just bond math. I don't want to get too.
No, that's fine. But when, because historically,
yes,
there are bonds that have traded at a very high yield.
Oh, no question. When I started, bonds were trading, 10-year U.S. Treasuries were 14%.
So, but it feels therefore like the bond market is a race to zero.
It has been in the past, because inflation expectations have been reduced so much that why were bonds trading in the late 80s at a double-digit yield? Because Volcker hadn't snuffed out, that's Treasury Secretary, not Treasury Secretary, excuse me, Federal Reserve Chairman Paul Volcker in the 1980s, snuffed out inflation by raising rates to double-digit levels. Since then, due to technology, due to deflationary pressures in the economies, the 10-year rate has gone down from 14% down to less than 1%. Now it's kicking around at 1.5%, but inflation now is higher than it has been in the last 20 years. And incidentally, in Europe, last month's inflation was higher than it's ever been, ever. And Europe still has negative yielding bonds. Something doesn't smell right, okay?
So essentially all bonds, junk bonds.
In my opinion, it's all about price. And if you're not buying a bond at the right price, you're getting stiffed. And if you're making a foolish investment, you could call that a junk investment, meaning it'll be a poor risk return investment. So yes, the old adage is there's a price for everything. Well, I don't believe the right price for US 10-year treasuries right now is 1.5%. Therefore, firstly, why would that not be the case? Well, when inflation's running at 6%, you know the math. You're earning a negative 4.5% real return. Okay. The other thing is, everyone assumes the credit quality of the USA is still gilt edged. It's not. The credit default swap markets are telling you that there's a higher and higher chance that the U.S. Treasury will not make full on their obligations. It's a real market out there. It's a credit default swap market. So it's not impacted by the Treasury. They're not in the CDS market, credit default swap market. They're not in there. And that's a market that's calculated on a daily basis between buyers and sellers of risk. Okay?
So it's a credit default swaps, essentially an insurance payment.
Bingo, buddy.
Yeah.
Bingo.
Yeah.
Exactly.
Wow. So,
and they were the things that they were the instruments that foresaw the default of Lehman Brothers and Bear Stearns and the like.
So how does the bond market get fixed? Because to me, it sounds like it's a broken market right now. I mean, it still works how it's meant to work, but in terms of earning a return, if all bonds are essentially negative yielding.
Yes, on a real basis.
On a real basis. Yes. And we know some people have to buy them.
Yes.
Because they're mandated to.
Right.
But essentially, it is a broken system. It's a fiat system that doesn't make logical sense.
Peter, I don't know how it gets fixed if they do not let yields go to their natural level. Now, that natural level is open for debate, but Stanley Druckenmiller feels that the natural level for U.S. 10-year treasuries would be 4.5%. Again, it's trading at 1.5% right now. There's other people that argue that the Fed is not impacting the shape of the yield curve. And I just say, come on, guys. There's an elephant in the room that was purchasing $120 billion worth of bonds a month. Tell me that's not impacting the yield curve. And if someone says it isn't, I think that you've never traded markets before, okay? There's bond bulls out there that swear that it hasn't impacted the yield curve. And I'll just go, guys, take your heads out of the sand, because supply and demand is what it is, and that's what sets the price of bonds.
Okay, sorry. What's stopping bonds reach their natural rate of 4.5% yield?
Again, a Fed in the market buying 120 billion of it per month.
Right.
That's just the biggest buyer out there by far is in the market. And when you're a buyer, you're soaking up sellers, meaning the way a yield rises, Peter, is the price goes down. And when the price of the bond goes down to reach an equilibrium level, the yield on the bond gets adjusted accordingly. So as the price goes down, the yield goes up. And we'll do a quick bond math here. If a 10-year bond were to move from 1.5% to 4.5%, where Stanley Druckenmiller thinks it should trade, the price or principal trading value of the bond would drop by over 25% in one day. Now, it's not going to move there in one day, but it could move there in 1 year. You could lose 25% of the principal value of your bond when it's earning 1.5% annually. God, that's unbelievable, isn't it? It would take you your entire maturity of the bond just to make the coupon payments back for the loss in principal value. Isn't it crazy?
Yeah.
So this is bond math, and this is like people don't appreciate. So then you can even extend it to a 30-year bond where the impact of what's called duration is more than twice as severe. 30-year bonds would drop by over 50% in value. 50. You've lost half of your value of your bond portfolio. Oh, but it's a risk-free asset. Oh, it is it? And I could lose 50% of my trading value just because the market interest rate adjusts in an open market way. I don't want any of that. It's picking up nickels in front of a steamroller.
Hold on, let me understand. So if the US government wasn't buying up the bonds themselves,
yes.
is it the Fed that buys them?
Correct.
You say, if the Fed wasn't buying them,
yes,
therefore there wouldn't be enough demand, so the rates would have to go up to fill that demand. Yeah, it's funny because the thing with bonds, everything feels inverse.
That's what it is, because if the price goes down, the yield goes up.
Yeah.
And that's your, it's like a toboggan, not a toboggan, a teeter-totter, okay? And it's basically when yields go up or they're allowed to rise to their natural level of supply and demand, the price of the bonds goes down. Because again, the bond is a contract with a fixed amount of coupons over its term. The only way the yield can adjust is that the principal value of that bond falls in price so that you buy something at 60 cents on the dollar that matures at 100 cents on the dollar, but that adjusts for the lower coupons than the open market rate, okay? So that's, again, it's a teeter-totter, okay? You got your coupons, you got your principal, and it's bond math, and it can really confuse a lot of people. Don't overthink it. I'll just tell you, when I started trading in 1988 rather, 10-year yields were 14%. Man, that's easy to make your bogey when you have a 10-year yield of 14%. Is it possible to get an 8% return in a pension fund when bonds are yielding 14%? Well, it's pretty darn easy, isn't it? You got the risk-free asset in the world yielding 14%. You got to be pretty good at losing 6% everywhere else in your portfolio just to come up with the 8% number. Now, though, CalPERS has the same assumed return of 8%, even though interest rates are 1.5%, which means they think equities will make up the balance, which means equities have to have double-digit returns forever and ever. Guess what, people? Your pension funds are underfunded, okay? Don't listen to what the government's saying. They are underfunded because the bond portion the equity portion cannot make up for the lack of yield in the bond portion. So
it is the pensioners who are going to be paying for this.
They will not get their anticipated returns in their pension funds, correct?
So the pension funds are growing but losing purchasing power.
The actuarial accountants are doing headstands to try and pretend the funds are what's called funded. I've talked to a few of these actuaries, and they are embarrassed and realize that it's almost impossible for the pension funds to be fully funded when 10-year rates are 1.5%.
How much are bond rates an indicator of the health of the economy?
Good question. Like, there's a lot of things go into the calculation of the 10-year rate. If we think of governments outside of a normal corporation, let's think of what a normal corporation is. A normal corporation has cash flows, assumed cash flows that will grow with the success of the company, the products of the company. That rate goes up and down independent of what the government rate is, okay? So you can have a US 10-year at 1.5%, and the high yield market itself is yielding around 4%, okay? So the spread is about 250 basis points between the two. But that high yield market, the spread will go up and down according to the health of that company. Flip that on its ear and say, is the government the same way? Strangely, when the government can print money and the economy is slowing, yields are going to come down because a slow economy means non-inflation, all the things that would cause yield to fall. The reality is, though, at some point, I think international bond investors are going to look at governments more like a corporation. What are the cash flows of the government that can satisfy the obligations in terms of interest expense as well as principal repayment of principal? And guess what the answer is? It's impossible.
Yeah.
It's over. You cannot possibly outgrow the debt spiral. It's mathematically impossible. And this is why I say fiat currencies will always have to debase because they have to print the money to solve the debt balloon. When your economy's not growing fast enough to meet your interest obligations and your principal repayments on your bonds, you got to print the money. It's got to appear from somewhere. If it's not appearing from your tax base, you got to print it.
Well, if they were companies, they would be essentially bankrupt.
Oh, listen, I won't criticize the USA because I'm in the great state of Florida right now, but if Canada, my home country, was rated as a corporation, it would be a solid junk bond borrower, okay? Canada would be a junk bond borrower if it was rated on the same scales that corporations are rated on.
Well, listen, if I run a company, I've run companies.
Yes.
If I had a magic money printer in my back office, then
wouldn't it be great?
I would never risk going bankrupt staying at home. I would always be able to pay my mortgage and buy my shopping if I had a money printer, but I don't have one.
So all I will say is this. People have not yet done the math, and they are still assuming that governments have the luxury of going to an auction and that auction being fully subscribed. There's something called a bid to cover ratio in the auctions, which indicate how much demand there was for the auction versus how much was issued. And a bid to cover ratio of 2 times means there was twice as much demand as was issued. What happens if that bid to cover ratio starts falling and it gets closer to 1 times, which means there was only as much demand as the auction? Then the next people are going to say, gosh, we're getting awfully close to the demand not being there. Maybe I better sell some bonds and lighten up on my own bond portfolio and in anticipation of worse auction results. It starts its own spiral or contagion. I've lived these markets. It's not fun when confidence is lost in the issuer of a bond. I've spent my life trading corporate bonds, but trust me, there's no difference when a government is involved.
Well, yeah. I mean, if I go back to thinking about Ray Dalio's video I've been watching on YouTube for the first time, is it How the Industrial Machine Works? But he talks about debt and credit. There's always a balance.
Yes.
Whenever there's credit, there's debt. And whenever there's debt, there's credit. At some point, they always have to balance.
Correct.
But when the government is issuing debt, they don't have the credit to cover.
Scary.
Yeah.
Yes. And look, it's risk happens fast, okay? You need to live with that understanding. You think it's all going to be fine until it isn't. And as soon as it isn't, it unravels really quickly.
And we saw 6.2% inflation quoted. Correct. I think everybody is in agreement. It is way higher than that. The US is currently double-digit inflation.
Well, if you use the same formula that they used in 1980 to calculate the original consumer price index, it would be over 14%. Apples to apples.
And I think we all know. I mean, we're experiencing it. Whether it's you filling up your car with, we say petrol, you say gas, whether you're going to Starbucks, whether you're going to dinner, everything is starting to feel really expensive.
It's the reality that this is the first time in my lifetime that I've experienced inflation like this. That's true.
It feels like we're in a very unhealthy place. And it feels like, we're talking about it because I have a show and you're part of a community and everybody isn't it. But I feel like there's a lot of people sleepwalking through this.
People, honestly, Peter, do not understand, including a lot of bond fund managers. The lack of understanding of bond mathematics is atrocious. Bonds have been in a 40-year favorable market to own bonds. That's now changed. Anybody managing a bond fund now has only experienced the positive about being a bond fund manager. This is a new paradigm for them. And old habits die hard, including the likes of Steven Van Meter, the bond king and everything. And he's going to outtrade this market. And I hope he does. But I just would not risk my hard-earned capital to pick up nickels in front of a steamroller. Okay, I don't want to risk earning $5 to lose $45. I'm just not going to do it.
Seems to me this is why recessions are important, and trying to avoid recessionary periods, which while are politically favorable, ultimately somebody's going to be in power, somebody's going to be leading the country when the collapse happens. Like a collapse appears to be inevitable now.
They are cyclical. Ray Dalio is very good at laying out the debt cycles, and there's long-term debt cycles and there's short-term debt cycles.
Could we argue we're in a super long-term debt cycle?
No question.
Because we've avoided the long-term debt cycle, or is that what we are in?
In my opinion, you started again with rates being at 14%, and they came down to under 1%. In the case of the European Union, they're at negative, so they actually went below zero. If you can explain to me the logic of lending someone $100 to get $99 back, please do it. But I'm afraid I can't explain that. And yet there's trillions of dollars of European debt that is trading at a negative yield.
Well, is it because what are their other options? Like if they leave it in the bank?
How about being smart? I mean, there's true. Some people are paying for the security of holding your asset in safekeeping and paying for that safekeeping. That is correct.
But is it also, if inflation just was 6%, if you leave the money, if you don't do anything with the money, you're losing 6% in purchasing power. But at least if you got a negative yielding bond,
you're losing more than 6%.
You're losing more than, hold on. Yes. That doesn't make any fucking sense.
Okay, thank you. You're right. It does not make any effing sense.
I don't understand.
Peter,
Greg, I don't understand.
I know, and I could not explain this. If you told me when I started trading bonds over 30 years ago, there would be a time where a bond was negative yielding, I would have laughed you out of, off the trading floor. But it's happened.
Can you not even, is there no reason you can attribute to this?
Yes, manipulation by European bank.
Okay. Because?
They just want to try and enhance the economy by having yields that are so low that people will borrow money to spend, for capital expenditures.
There are multiple cans being kicked down the road here.
Buddy, I've never been so bearish on bonds in 30 years. And I'm okay if I'm wrong. I just know I won't be, okay? Because it's only mathematics. That's what a bond is. That's why it's so beautiful. It's only mathematics. There is no subjectivity to a bond except for the fact that the borrower may not repay you. Other than that, it's 100% contractual mathematics.
Okay, so central banks can issue bonds.
Well, essentially, the central banks and the treasuries are, they work hand in hand.
Yeah. Companies can also issue bonds.
Companies issue bonds all the time, correct.
Is that a similar size market or is it a lot smaller?
Oh, way smaller.
Way smaller.
Yeah. So total global debt is about $400 trillion.
Holy shit.
400 trillion, correct. Holy shit is right. Of which governments account for at least, almost 3/8 of that, okay? The others are banks and high-rated corporations, and then there's lesser-rated corporations called junk bonds, which are a very much smaller. But total global debt, $400 trillion. What's total global GDP?
I just don't know.
About 100 trillion. So total global debt is 4 times as large as the global economy.
Right.
Yes. Well, think about that for a second.
Yeah.
Essentially, it would be the same as you borrowing 4 times your annual salary, not collateralized by a house or anything. Does a bank lend you 4 times your annual salary, not collateralized by a house?
Nope.
Not in your life.
Only with a house if it is collateralized.
Correct.
And with usually a decent deposit.
Correct. Yeah. 20% down, So this is what credit markets are very interesting. They're no different than an equity market, except there's a lot less subjectivity to it. I always say, look, equity guys are so bullish, right? And bond guys are so pessimistic. Equity guys, this tree will grow to the moon. And bond guys are like, look, trees don't grow to the moon, and stop telling me that equities are, I'm going to dictate what's happening in the world, because total global debt at 4 times total global GDP is far larger than the equity markets. Everyone always looks to the equity markets to get an indication of how things are going. Stop it, guys. The equity markets are a subordinate claim to the debt markets, and the debt markets are far bigger than the equity markets. Always look at the credit markets to judge the health of an economy.
Okay, so let's talk about this Volcano bond that Bukele announced on stage in El Salvador. Samson was there.
Were you down there?
No, I wasn't. I couldn't make that one. I've been away for too long. To me, it seems kind of interesting, but I want your perspective on it. I know that El Salvador bonds have a 13.5% coupon. This one is a 6.5%.
Right.
The idea is they raise on the first bond $1 billion, dollar denominated, and they're going to put $500 million into buying Bitcoin, $500 million into mining infrastructure, as I understand. And then they'll pay the 6.5% coupon. I think there's a lockup. I'd have to confirm that. But
it's 5 years.
It's 5 years. Yeah. Their assumption is Bitcoin will do its thing, and that 500 million will increase in value.
Yeah.
And then after the 5 years, they will be selling off the Bitcoin.
They could be. There is a participation in terms of the performance of the Bitcoin price over that time, in which the bondholders will participate in the performance of the Bitcoin price to the upside, and they won't be penalized to the downside. But I'll promise you that the price of the bond will go lower if Bitcoin doesn't do its thing. So the price, it won't be a contractual participation in the price, but in terms of the Bitcoin price, but the price of the bond will reflect the Bitcoin price.
So the bond will be a derivative of Bitcoin?
The bond there's two components of the bond. One is a Bitcoin option, correct? And the other one is a pure cash flow consideration on the credit worthiness of El Salvador. Or Bitcoin City. Let's be.
Yeah.
And the question is, are they ring fencing Bitcoin City from the El Salvador counterparty risk? Okay, and that's where some of the technicalities of the issue can come into play. If they're able to ring fence the Bitcoin City component, in theory, Bitcoin City could have a far higher credit quality than El Salvador as a whole. These are some of the issues that I'm not aware if they've been ironed out or not, but there's certainly an argument that the Bitcoin City and the thesis behind Bitcoin City could be a pretty attractive investment opportunity, right? Barring not even considering the performance of the Bitcoin price. Hey, you're going to build a mining infrastructure that's going to mine Bitcoin, and Bitcoin mining is not, there's a component of it that's sensitive to Bitcoin price, but in theory, the difficulty adjustment, as you know very well, should allow miners to make money regardless of what the Bitcoin price is. Someone may look at that and say, well, Bitcoin City, mining infrastructure, passports, new people coming in to be citizens of El Salvador. Hey, I sort of like that. And is 6.5% rate there? Is that attractive for all of that optionality? There's certain lenders out there in the world that I think will say, give me some of that. So
if the bond is fully subscribed,
yes,
and during the period of the lockup that the Bitcoin just does a 5-10x, like an amazing thing, it ends up being $300,000-$400,000 a Bitcoin, those bonds are going to trade on the open market at a much higher rate than 6.5%.
Correct, sir. So that means their price will, if they trade a higher rate, they'll trade at a lower yield at a higher price, because the 6.5 will be extremely attractive. So people will bid up the price of those bonds, and the yield conversely will decline in yield, and maybe that yield becomes 2%.
So what do you think of this bond then?
I think it's an awesome experiment in getting I won't use the word circumventing, but in terms of putting more funding options on the table for a country that's so far been hostage to IMF, how do we say this politically correct? Hostage to IMF posturing. They are trying to increase their own funding flexibility outside of the IMF safeguards. I'd say that with quotes, IMF safeguards. There's other ways I could describe the IMF.
When the IMF lends money to a country, It's just a loan.
It's not just a loan because there are contingencies that, you know, require, certain benchmarks to be met, and covenants that, in bond terminology, covenants that need to be met. And I'm not aware, I've never lent money to El Salvador, so I've never gone through any of their covenants. But trust me, one of the things that's very restrictive about lending to a risky counterparty is the lender makes sure that the borrower is somewhat constrained into what they can do with the money. Do you have what's called cash flow sweeps, where you get the money back before they're able to spend excess cash flows on other projects? All these things are covenants that exist in certain bond structures. I'm not aware of what the ones are for El Salvador, but I anticipate that the IMF has some pretty strict covenants in their bond package.
Okay. I mean, the talk is of El Salvador doing up to 10 of these bonds.
They have to do one first.
Sure.
And I would definitely say if one goes off, don't flood the market. But if one goes off and the price performance of the bonds in the aftermarkets reflects good demand, then I would do another one, 100%.
What do you think the risk is with these bonds? Because one of the things I like about it is that it is, at least half of it is backed by Bitcoin.
Honestly, Peter, I need to be very careful here. This bond, in my opinion, is attractive for investors who do not have the opportunity to own Bitcoin outright.
Okay.
You are different, okay? Now, and so am I. And then there's some whales out there that have so much Bitcoin at risk that they may actually want to go the other direction. And they might want to take some pure Bitcoin off the table and earn a yield to a counterparty like El Salvador that they want to succeed, right? If this goes well, this is going to be good for the Bitcoin ecosystem. Well, I'm sure I'm not going to call them philanthropists, but there's certainly some well-wishing whales out there that might fund this project just to prove that this is possible.
And stick a middle finger up to the IMF.
But nothing comes for free. I mean, we are not a philanthropic organization. When I say we, I mean the Bitcoin community as a whole. You could not rely on that to continue indefinitely. So this is a bit of a litmus test. There's no question. Will you buy this bond? I'm not saying whether you will or won't, but certainly there's some people in the position who've been involved in Bitcoin as long as you have that would look at it and say, the greater good is that this succeeds for El Salvador. So therefore, I am going to help fund this project to ensure its initial success. I think there's quite a bit of that might come to the table.
I agree. I think,
and not being the underwriter, meaning, the Blockstream and Samson Maos of the world and everything, I don't know. I haven't canvassed the buyer base, but I sure hope that they had done some pre-work on this to give them a level of comfort that this would be the case.
Yeah, my assumption is they would have. I personally won't be buying it because I'm not wealthy enough, but I do support the idea. I hope it's successful, but I hope it's successful for a different reason, not just for El Salvador. I actually hope it's successful because if this works, this will highlight to other countries around the world.
100%.
There's another alternative way.
Yeah. And don't forget, then you got to be careful that you don't get everyone jumping into the same pool all at the same time, right? Because then it will ensure that there's oversupply versus demand, meaning every single country wants to do this. All of a sudden you have $100 billion of desired supply. Well, that's a lot. The market's not big enough to hold, the whole Bitcoin market's only $1 trillion. You're talking $1 billion. Well, that's 1/1000th. But all of a sudden, if it's 100 billion, you're talking 1/10 of the market wants to get absorbed into Bitcoin bonds. Then you're talking a big dilution. So you can't do too much. It's a process.
But it's a useful test.
Honest to gosh, I really want this to succeed, and I really hope that the underwriters have done their best Wall Street imitation, where they would have gone around and canvassed a number of very key buyers and said, on the QT, we're looking at bringing this to market. Can we put you in the book, an initial order book that would justify, I'm going to throw a number out. Wouldn't it be amazing if they had $600 million worth of demand prior to even announcing the issue?
Because closing the gap then will be
Easy.
fairly...
And you want it to be oversubscribed, meaning you want it to appear that there was more demand than the issue size. And we can get into some of the technicalities as to whether there's a syndicate short on these bonds and all this good stuff.
What's a syndicate short?
It's when if you bring $1 billion bond issue and the syndicate sells more than $1 billion, essentially settles the issue short, meaning they have to go back into the market and repurchase some of the bonds to satisfy that short. It ensures that there's a bid under the market and that the price of the bond, if it's issued at 100 cents on the dollar, may trade up to 102 or 104 cents on the dollar. Believe it or not, in bond land, that's huge, right? That 4% is a 4% return at time zero. Well, when 10-year rates are 1.5% and you can make 4% just because the price of the bond issue went up 4%, from 100 to 104, that's a good day's work in the bond market. Okay?
Interesting.
Oh yeah. So these are all things that Wall Street will do. They'll have a syndicate short. They'll have their pocket buyers. The pocket buyer will be like, okay, look, I'll put 200 million in the book and I'm good for another 200 million in secondary market trading. Well, guess how coddled that buyer gets, right? How many baseball games does that buyer get to go to a year on behalf of the Wall Street syndicates? Like, come on. That's how it works though. Right? So, and these are huge funds. These are funds that have trillions of dollars to invest in bonds.
So do you think some of the Wall Street bond traders might take a look at this?
I can't comment on that. I'd certainly, if I was in my old chair, would I take a look at it? 100%. In my old chair, I would have taken a look at it. Would I have bought it? I'll tell you what I would have done. I would have broken it down into its components, its pure cash flow characteristics, its Bitcoin optionality, and I might have gotten too smart by half and sold out call options on Bitcoin and covered some of this and done all that stuff that a hedge fund pretends they do. and then I could have been in the game. That being said, at my old seat, I would have been hopefully allowed to buy Bitcoin as well. And so you have to be careful. Is it a fund that's allowed to buy Bitcoin or a fund that isn't allowed to buy Bitcoin but wants to get Bitcoin optionality exposure?
Why are these funds still not able to buy Bitcoin?
Again, the investment policy guidelines. We talked about that at the beginning, right? These things are set by old men like Warren Buffett and Charlie Munger, okay? Time will take care of their old age, but for now, they are the people setting investment policy guidelines for pension funds.
Right. Okay. Sorry. Help me understand that.
Yeah.
So it's not the fund itself. These are policies that are created outside
by committees, pension trustees that set these policy guidelines. That is correct. So don't forget. Let's say you're the Chicago firefighters pension plan. You have, on behalf of your pensioners, the obligation to try and fund your pension plan. You will farm out an asset mix to specialty managers across the board based on an asset allocation plan defined by your trustees. So the trustees could say, well, the Chicago pension firefighters, they're really risk averse. We're going to be 90% in bonds. Well, that stinks, doesn't it? But there are funds like that. And then there's other people that are like, look, I'm very, I'm proactive. I want to take risk on behalf of my pensioners. And these guys might be instead of the Chicago firefighters, let's say they're the circus act, the Chicago circus guys, the trapeze artists. They take risks their whole life. Well, they might be 90% equities and 10% Bitcoin, right? They live with risks like that. So it's a balancing act across different pension guidelines across different, and some of it is regulated by the state as well, because there is pension plan guarantees by various states in the USA, where if the pension plan isn't fully funded, it will be subsidized by various government entities. So there's a pension plan. It's the Pension Plan Guarantee Board or something like that. So
it's a bit like the FDIC.
Correct, except for pension plans.
It's no wonder the government hasn't got any fucking money.
Peter, there's just so many different moving parts in all of these policy decisions. And this is what a lot of Bitcoiners don't understand. Like I love the Bitcoin community. They just don't understand how big money works, okay? Why aren't they 100% in? Well, because it doesn't work that way. It takes a long time to change these policy guidelines. A lot of the people who make these decisions, again, are people that have been managing money for 40 years. They don't understand how an iPhone works, let alone how the blockchain works, okay? And these are the people who are making the decisions.
It does seem to me, though, that pension funds are almost the perfect vehicle for investing in Bitcoin because they have that long time preference.
Bingo. The question is how much, right? And that's what we have to come down to. The wrong answer is 0. How much Bitcoin should they own? Well, the wrong answer is 0. What is the right answer? And the right answer,
start at 1%.
You got to get off 0. And borrowing from Pomp, get off of 0. The right answer, in my opinion, somewhere between 10 and 20%.
Okay, that's big.
If it goes to 10 to 20% of all pensions are allocated to Bitcoin,
we probably hit our plus 1 million.
Easy.
Yeah.
Well, just do the math and you'll see the demand side of the equation. Again, if total, I've run through this math with you before, but if total financial assets in the world are $900 trillion, that's what they are, okay? All bonds or all debt, all equities, all real estate, all gold, commodities, fine art, store of value, total of $900 trillion. I think Bitcoin easily captures 5% of that market. What's 5% of 900 trillion is 45 trillion. What's 45 trillion divided by 21 million? It's over $2 million of Bitcoin in today's dollars.
But that's not even counting for price slippage when a lot of people want to buy.
How about this, brother?
Yeah.
It has to go through my price before it gets to $8 million. So let's start with $2 million, okay? And the point is, the way it gets there is when pension funds say, I got to get my 5%. Because 5% is a minimum. And what if they say 10%? Well, then it's 90 trillion divided by 21 million, and all of a sudden it's $4.5 million of Bitcoin.
See, they are the perfect vehicle for Bitcoin. They have long time preference.
And by the way, what are their alternatives? They're pretty stinky right now. 10-year bonds. And gold is way better than owning a bond. And congrats to our friend Peter Schiff, okay? Look, here's the picture of, I'm going to put Shifty on his head, okay? Shifty is on his head because he actually stood on his head for once, okay? Shifty, you're standing on your head, okay? He stood on his head because why? He actually appropriately called bonds return-free risk. That's a great expression. Bonds are return-free risk. Gold is better than bonds. Okay, so we're putting Shifty on his side now, okay? Because he correctly said that gold is better than bonds. But gold is nowhere as good as Bitcoin. So anyway, thank you, Peter. Love you, man. I love your son. I love everything that you try and do, but at the end of the day, you've been so wrong on your risk allocation because he was 99 yards, or as we'll use he was running for a try and he was inside the 22-meter line and he's running down and he fumbled not the ball, but
we call it
the rugger.
We call it the ball.
The ball. He fumbled it. What a loser.
He knocked it on.
Well, he knocked it on. Beautiful. Exactly.
Yeah.
Okay. Unfortunate, but he has a great kid that's going to make up for it. So.
Oh man, I was with Sailor a couple of days ago.
Okay.
We got into an issue you love.
Oh, good.
Bitcoin is digital energy.
Oh, he's the man.
Yeah. So I struggled with that as a concept for quite a long time. I was like, what do you mean Bitcoin is digital energy? You know, you're mining the Bitcoin and you're selling it. How is that storing energy? It's not. It's storing wealth. I still struggle. I understand why people want to sell it as that, but I don't 100% understand why it's digital energy.
I guess it's easier for me as an engineer to appreciate that because I grew up with the law of conservation of energy, right? That's embedded in my brain. Energy can't be created or destroyed. It is the law of conservation of energy, and Bitcoin proof of work is storing the value of somebody's time and energy to be consumed at some point in the future in a conservation of energy principle. And I hope I didn't use this on one of your podcasts, and forgive me if I did, but I'll go back to when I was 20 years old. So over 35 years ago, I was working, one of my summer jobs was working as a asphalt shingle installer. I might have made $40 that day, pounding shingles in a hot summer. 8 hours, $5 an hour. I made $40 35 years ago. What do you think that $40 is worth to me today after I stored it for over 35 years?
Couple of bucks.
Oh, how horrendous is that? I can't even buy a beer for 8 hours of work. Okay? Because again, the purchasing power has gone down to $6.80-ish sort of thing. Do you know what I mean?
Mm-hmm.
And at the end of the day, that's what fiat does. It robs you of energy. And this is key. If you understand that my time and energy was worth something in that hot sun, I improved the value of that house. My work energy went into that house, improving the value of that house. Then I was rewarded for that work energy and I stored it in an inferior asset that lost its purchasing power over time.
So it's all money energy, but some is better energy than other.
Interesting. It should be, but it's not. So fiat is certainly not energy. Fiat, there's no conservation of energy principle with fiat. They can just make it out of thin air. You can't make energy out of thin air. Energy exists. And its conservation of energy is the first law of thermodynamics. And Saylor says it because he's a rocket scientist, and I appreciate it because I'm a mechanical engineer. And I know people that are as smart as Saylor. The difference with Saylor is he's a walking mainframe who can actually communicate with the common man. Most rocket scientists are, gibberish people. They speak in math and, they make funny jokes that no one understands because it's like the square root of 3. Like, that kills me. Oh, fuck off. I have no idea what you're talking about, right? But so Saylor gets it. He's like, he's a walking mainframe that basically understands. Common man. Now, that being said, you'll say, okay, I still don't quite get the conservation of energy. Hopefully, thinking about working 30 years in sweat, hot sun, you come to use that money 30 years later, and it's worth nowhere near what your purchasing, what it would have been when it was worth $40 35 years ago.
So is gold metallic energy?
Yes, sir. Absolutely.
Okay.
How is it formed?
It's mined.
No. How does it get formed in the universe?
Supernova.
There's lots of ways, but those things are high intensity energy things.
Okay.
There's scarcity value to gold. I mean, the beautiful thing about gold is you don't produce it. You don't put, it's not like producing concrete. You know what I mean? Like you don't put half a mixture of stones and, concrete and sand and water to produce concrete, or cement rather. Your cement, sand, stones, and water equal concrete. You can't produce gold that way. You can get gold out of seawater. You know that there's more gold in seawater than is on land. The problem is getting it out of seawater is a very polluting, arsenic and all those things. But yeah, that energy could extract gold out of seawater. That's a big thing, right? Everyone says we're going to mine an asteroid. What the fuck are you talking about, mine an asteroid? Just go to your backyard and suck in enough seawater and get the gold out of the seawater. It's true.
Yeah, you can see it on one of the documentary channels.
Anyway, look, this is all good. I still am not dissing gold like Saylor really does. There's a friend of mine, Lawrence Lepard,
we interviewed
Lepard. He's brilliant.
Such a great guy.
I love Lawrence, and I love how he manages risk. And there's just a different risk tolerance between Lawrence's clients and Michael Saylor's unit holders.
In our show that came out today with Saylor, he calls gold the enemy of Bitcoin.
Darn. I respectfully disagree with Mr. Saylor because most gold bugs, and I'm going to specifically call out a couple of them, Lawrence Lepard, Santiago Gold Fund, Brent Johnson. These guys get it. They've done the homework. They understand that fiat is the enemy. Now, they've chosen a store of value that's $10 trillion. There's no doubt in my mind that Bitcoin will be far more valuable than gold. But if you ask me, who's the real enemy? Bondholders or gold holders? I'm like, come on, don't even start. Firstly, bonds are 40 times the size of gold. And they're 40 times as stupid as the gold holders, okay? because they really don't know mathematics as far as depreciation or debasing of the currency goes.
Fair, man. Fair. Well, listen, look, it's always a pleasure to have you on here.
It's great to be here, guys. I mean, I want to thank your team and everything. It's nice to be face-to-face and in beautiful Hollywood Beach, Florida. I love this state.
I do. It's got some really cool bits and some really weird bits, and that's what I like about it.
It's eclectic. It's I traveled down through the north of so I drove from Canada down to Miami.
What?
Yeah.
How long did that take?
A couple of days, like 3 days.
That must have been fun.
I stopped in some great spots, including Gainesville, Florida, where the University of Florida is. Man, that is a sweet town, and I really look forward to going to a couple of football games there. I'm not going to live down here full time, but I'm proud to say that I'm a property owner in the state of Florida now.
Nice.
And yeah, listen, Canada's a great country, but we got a lot of wood to chop up there.
Oh, are you kind of like planning your exit because it's all a bit weird?
I'm
optionality.
I'm not. Yeah, optionality's correct.
Okay.
And here's the thing: I have a great wife that she likes Bitcoin, but she doesn't love it. And if I put everything in Bitcoin, I may not have a wife. So she said, "Okay, put it in another hard asset." And I said, "Look, real estate in Florida, on a dollars to dollars basis, real estate in Florida is quite attractive relative to real estate in Canada." So
well, keep that wife, man.
Yeah, they keep the world going, man. They do, eh? So, yeah, thanks again for having me. And I'll say one more thing. We talked a lot about bonds here. Bonds are the most important financial contract in the world. They're the biggest. They run all markets, okay? This is what people don't understand. When the credit markets get sick, all other markets absolutely get disastrously ill, okay? Why? Because credit runs the world in a capitalist system. I really want the El Salvador bond experience to be positive. I hope it is. But regardless, that's $1 billion in the context of 400 trillion. 4,000 times as big. Oh, I guess it's more than 4,000. Anyway, it could be 40,000 times as big.
It's a big fucking number.
It's a big fucking number. And that's the real elephant in the room. Please, please, please do your homework. If you own bonds and you own no Bitcoin, that's the people I feel sorry for. The gold holders,
they'll be okay.
They'll be okay.
Get some Bitcoin.
Yes, sir.
Greg, love you, man. Good to see you.
So great, guys. Thank you very much, and look forward to having another chance to meet up in Miami on different occasions. Right?
We'll make it happen, dude.
All right.
All right. Cheers.
Thank you, guys.